How does a massive legacy tech giant suddenly find itself staring at a 450% explosion in AI orders, blowing past its own $5 billion target with months to spare?
Yeah, it's honestly a wild scenario.
It really is. Welcome, everyone, and thank you so much for coming to watch the video today. We are really thrilled to have you here.
Definitely. Thanks for tuning in.
So this discussion is part of our ongoing Earnings Unpacked series. It's basically our consistent way of shortcutting your path to being well-informed on major market movers.
Exactly. We do the heavy lifting so you don't have to.
Right. And our mission today is pretty straightforward. We are breaking down Cisco's blockbuster Q3 2026 earnings call. We want to separate all the AI hype from the actual tangible financials. So we'll look at their prepared presentation and then dive really deep into the analyst Q&A to see how they're capitalizing on this AI boom.
And I think what's fascinating here is not just the sheer volume of revenue, though the numbers are crazy.
Oh, they're massive.
Right. But it's really about how Cisco is rewiring its entire business to handle the scale, the speed, and the complexity of the AI era.
Yeah, so let's get right into the prepared presentation summary and unpack those top-line numbers. Because they're just financial blockbusters.
They really are.
Cisco delivered a record Q3, the fiscal 2026 revenue of $15.8 billion. That is up 12% year over year.
Wow.
And their adjusted earnings per share was $1.06, which is up 10%. Both of those completely crushed the high end of their own guidance ranges.
And it wasn't just isolated to one little area, you know? It's a broad-based boom.
Right.
Total product orders surged by 35%. And even if you take out the hyperscalers, those giant cloud providers orders still grew 19%.
That's significant.
Yeah, enterprise was up 18%, and the public sector was actually up 27%.
But the AI infrastructure surge is really the staggering part. Just in Q3, they pulled in $1.9 billion in AI orders from hyperscalers. That puts their year-to-date orders at $5.3 billion. I mean, they easily cleared their previous $5 billion expectation, and that was supposed to be for the full year.
Which is why they had to completely rewrite their future outlook. Management noted they now expect $9 billion in AI orders for fiscal 2026.
Wait, $9 billion?
Yeah, which is 4.5 times their total for fiscal 2025.
That is insane.
It is. So they raised their full-year fiscal 26 revenue guidance to between $62.8 and $63 billion. And they even explicitly teased at least $6 billion in AI hyperscale revenue for fiscal 2027.
So to handle all of this, they announced a massive strategic restructuring. We're talking a $1 billion plan, with $450 million of that hitting in Q4.
Right, because they have to aggressively reallocate their resources.
Exactly. They're pivoting hard towards silicon, optics, security, and AI.
Yeah, they mentioned shipping like 750,000 400 gig pluggable optics.
Okay, let's unpack this Silicon One advantage because it's crucial. It's basically like, okay, imagine a restaurant deciding to stop buying bread from a vendor.
Right.
And instead, they just go out and buy the entire wheat farm and the bakery.
I like that.
By controlling the silicon and the optics themselves, they essentially control their own destiny in the supply chain.
Exactly. And that vertical integration is what the analysts really drilled into.
Yeah, the Q&A session gets intense. But before we jump into the Q&A, which is really where the analysts try to poke holes in management's narrative, if you are finding these insights valuable, please click like, share the video, and make sure to subscribe so you never miss an episode of Earnings Unpacked.
It really helps us out. So moving into the Q&A session, the prepared remarks are kind of the victory lap, but the Q&A is where the mechanics of the business actually get tested.
100%. So let's go question by question. Question one came from Amit Dariani at Evercore ISI.
Right.
A summary of his question, he basically asked about the durability of the double-digit revenue growth implied for the back half of the year. And specifically, he wanted to know the value proposition of Silicon One compared to merchant silicon.
Yeah, the build versus buy question. And management's response to that was pretty firm. They explained you have to separate AI hyperscale from the core portfolio.
Okay.
The core is going to grow at a normal 4 to 6% long-term model. But AI is what will hit that $6 billion mark in fiscal 27.
And on the silicon side?
They said Silicon One is a massive differentiator. Controlling the silicon ensures supply chain reliability. It's literally the main reason hyperscalers are choosing them for these massive scale across deployments.
Makes sense. All right, question two is from Taliani at Bank of America. Not everyone is convinced by this sudden jump, so he had some skepticism.
Oh, definitely.
To summarize his question, he noted that non-AI orders grew 19%, and he asked if this was just an artificial pull forward of demand. Like, are enterprises panic buying because of supply constraints?
It's a fair question. The company's response was actually pretty balanced. Management admitted there might be a very modest pull forward, but they argued the growth is real. They pointed out that 4 to 5 percentage points of that acceleration were purely from price increases.
Oh, so same volume, just higher prices.
Exactly. Plus, they said their Q4 pipeline didn't degrade at all. It actually grew healthier throughout the quarter.
Wow. Okay, question 3 was Ben Wrights's over at Milius Research. Pushing further on that non-AI math, his question summary is, if the long-term non-AI growth model is 2 to 5%, shouldn't the recent price increases push them well above that baseline next year?
Yeah, he was really checking their math there.
Totally. So what was the response?
Cisco's response clarified that the total model was 4 to 6%, with networking specifically at 2 to 5. But they agreed with him that price increases will help offset some tough year-over-year comparisons.
Did they give hard numbers on that?
Not yet. They promised more specific guidance on that in 90 days.
Got it. Okay, moving to question 4 from Aaron Rakers at Wells Fargo. If we connect this to the bigger picture, all these orders mean nothing if you can't build the actual boxes.
Precise.
So to summarize his question, Aaron asked for an overview of the supply chain, specifically regarding wafer allocation for Silicon One. And he asked what exactly is driving the massive implied jump to $3.7 billion in AI orders for Q4.
Cisco's response here was super confident. They stated they have 0 decommits.
Zero.
None. By controlling their own silicon, they've secured supply all the way through calendar year 2026.
That's huge.
It is. They also said they've reduced memory utilization up to 50% less in some new wireless gear and invested heavily in advanced purchase commitments.
And what about that Q4 jump?
Management emphasized that AI orders are just highly nonlinear. They're driven heavily by these massive scale-out optics wins that just hit suddenly.
Right, it's not a smooth curve. Okay, question 5. This was from Meta Marshall at Morgan Stanley. A quick summary of her question. She asked if there was an increase in the duration of these AI orders because of supply chain concerns. And she also requested a split of the gross margin headwinds, looking at memory costs versus product mix.
So in response to the order duration, Cisco said they are not seeing any duration increase. Customers are just planning really well in advance.
Okay, that's a good sign.
Yeah. And on the margins, which stabilized at 66%, they explained that product mix is actually the bigger headwind.
Because of the heavy hardware growth.
Exactly. Heavy hardware growth versus flat software. But they said it's being offset by world-class supply chain productivity and those price hikes we mentioned earlier.
That makes sense. All right, question 6 from David Vode at UBS. Here is where it gets really interesting because not every part of Cisco is booming. Like, what about software?
Right, the legacy stuff.
Yeah, so his question essentially asked for an update on the struggling security portfolio and the transition of the Splunk business to cloud subscriptions. And he also asked how the margin dynamic works if software doesn't grow to offset hardware costs.
So management's response noted some really strong double-digit growth in firewalls, which shows the security portfolio is finally turning a corner.
I'm good for them.
And Splunk. The Splunk cloud transition will continue to drag revenue slightly, but they should lap those tough comparisons next year.
And the hardware costs.
They said hardware margins are currently so good that they are essentially offsetting the lack of software mix.
Incredible. Okay, question 7 is from Samik Chatterjee at JP Morgan. Summary of his question. He asked about the business implications of Project Glasswing and the Anthropic Mythos AI threat testing. And he also asked whether the new restructuring plan will drive operating leverage next year.
Right. So Cisco's response clarified something really important. The $1 billion restructuring is not a cost savings play.
Oh, it's not?
No, it's a strategic realignment to move faster in AI and optics.
Gotcha.
And regarding that Mythos threat testing, they noted it's making customers hyper-aware of unpatchable legacy tech, so that will likely drive a massive modernization cycle, rather than just pure security software sale.
People have to buy new hardware to stay secure. All right, question 8 was from Carl Ackerman at BNP Paribas, but asked via Sam Feldman. And I love this pushback. If management is so smart, why were their initial AI targets so embarrassingly low?
Yeah, he went right for it.
He did. His question basically was, why was the fiscal 26 AI order guide originally so conservative?
The response to that was just honest. Management admitted the market simply moved faster than expected.
Yeah, nobody has a crystal ball.
Exactly. Hyperscalers tested Cisco silicon, they got comfortable with it, and then suddenly just dropped these massive unforecasted orders into the pipeline.
Just a tidal wave of demand. Okay, question 9 is from Ben Bolin at Cleveland Research. To summarize, he asked about Cisco's internal AI inference tool, which is called Circuit.
Right.
He asked what it's solving for and if other large enterprises are doing the same thing.
So in response, Cisco explained that they use Circuit to build internal guardrails. It allows employees to safely query proprietary company data.
Like auto-generating a sales deck based on internal specs.
Exactly, without leaking it to the public. And they noted that their enterprise customers are building the exact same internal infrastructure.
Oh, so that's driving traditional data center orders.
100%.
Makes total sense. Okay, question 10. Michael Eng at Goldman Sachs. He really dug into the weeds of the pricing strategy. His question asked how exactly they extracted that 4 to 5% price benefit on non-web scale orders.
Yeah, that response was fascinating. Management explained they changed their terms and conditions.
Oh.
Yeah, they slashed the grace period for honoring old quotes from like 30 to 45 days down to just 15 days.
Wow, that's aggressive.
Very. But it allowed them to rapidly pass on rising memory costs to the customers.
All right, final question number 11. George Notter at Wolf Research. He followed up on that, and his question asked if the July quarter-so Q4 would see an even more significant revenue impact from pricing since the hikes would be fully baked in by then.
And Cisco's response was simply yes. On the order side, the price increases will be fully absorbed.
Because of the lag time.
Right, because of the lag between taking an order and building the product. Q4 is when that pricing will finally hit the revenue line, which is going to be a critical shield against peak memory costs.
Well, that covers all the analyst questions.
Right.
So let's provide a high-level wrap-up for everyone watching. What are the main themes from both the presentation and the Q&A?
I think synthesizing it all, Cisco is effectively riding a two-pronged rocket right now.
I like that analogy.
Yeah, on one side, you have a 450% surge in AI hyperscale orders, and that's driven by their proprietary Silicon One technology.
Right.
But on the other side, you have a massive traditional enterprise refresh. And that's driven by everyday companies scrambling to build their own internal AI data centers.
It's an incredible pivot.
Yeah.
And it leaves you with a really provocative thought to chew on.
Yes.
Cisco's $1 billion restructuring proves they are willing to ruthlessly cannibalize their own legacy operations to chase the AI horizon.
Yeah, they're not looking back.
No, they aren't. And it raises an important question for you to explore. In an era where AI moves at blinding speed, is owning your own silicon the only way for a legacy tech company to survive the next decade of supply chain wars?
That is the big question right now.
It really is. Well, thank you all so much for watching. If you liked the video, please click like, share it with your network, subscribe to the channel, and definitely stay tuned for upcoming content on Earnings Unpacked. We'll see you next time.